Good day, ladies and gentlemen, and welcome to the Stefanutti Stocks Annual Results Conference Call and Webcast. I would now like to turn the conference over to Mr. Willie Myburgh. Please go ahead, sir.
Welcome to the Stefanutti Stocks Financial Results Presentation for the 12 months ended 28 February 2019. This presentation is available on our website. I will present the 12-month overview and the operational overview. Antonio will present the financial results, and I shall close the presentation. The overview for the last 12 months. The conditions in the South African construction market remain difficult. The shortage of public and private sector spend has a definite impact on the performance of all our businesses. The group's operating profit was negatively impacted by 263 million rand relating to potential future unrecoverable costs on a large public sector power project in South Africa, which had to be raised in terms of International Accounting Standard Statement number 37. The group is actively pursuing its contractual rights to ensure that this cost will not materialize. Before the end of the third quarter 2019, a ruling will be made whether the client needs to fund these costs until completion of the project. Furthermore, there are additional contractual claims and compensation events the group is pursuing on this project. The liquidation of an open-pit mining contract client, plus an increase in delayed payments on the funding of the tower project have resulted in the group experiencing short-term liquidity pressures. The UAE operation once again made a strong contribution towards profits. The cross-border operations continue to perform well. Unfortunately, disruptive and unlawful behavior of communities and informal business forums continue to negatively impact the group's performance throughout the country. Key indicators. The operating loss for the 2019 financial year was 158 million rand, which was negatively affected by the inclusion of a 263 million provision required in terms of IAS 37. Cash on hand at the end of the year was 881 million rand. The debt to equity ratio, excluding impact of IFRS 16, is 33%. Capex, excluding IFRS 16, reduced to 109 million rand. Safety remains high on our agenda with a continuous improvement of safety statistics. The lost time injury frequency rate at the end of February was 0.02 and the recordable case rate was 0.36. The group is a level 2 broad-based black economic empowerment contributor, and we are working towards obtaining a level 1 status. We are now moving to the operational overview. The current market overview. The South African construction market is currently at a historic low, resulting in a shortage of work coupled with an aggressive tendering environment. Despite the reduction in the current order book to 11.5 billion rand, certain sectors of the economy still provide opportunities, such as industrial and office buildings, both locally and cross-border, petrochemical tank farms and plant shutdowns, road and bridge infrastructure, surface mining-related services and open-pit contract mining, and water and sanitation treatment plants and bulk pipelines. There appears to be a deliberate increasing trend by some clients, both in the public and private sectors, to delay the certification of work and payments. This has a negative impact on working capital. The operations and order book. The order book in all the business units has gradually declined over the past 2 years. Construction and mining makes up 60% of the order book. Although the order book in mechanical and electrical is low, anticipated awards will alleviate the pressure. The biggest reduction in order book is in our building business unit in South Africa, where tender margins are unrealistically low. Construction and mining percentage turnover and order book by sector The yellow indicates the turnover to the end of February this year, and the blue indicates the current order book within the various sectors. Transport, infrastructure, and surface mining-related services make up the majority of work in construction and mining. There is an uptick in the water and sanitation and pipeline sector, and we are expecting imminent awards. Although the 3-year and beyond order book has reduced, an expected award for an open-pit mining contract will improve the situation. The current order book of work outside South Africa is 40%. This is predominantly from projects in Botswana, Swaziland, and Zambia for private clients. The majority of public sector work outside South Africa comes from Botswana and Swaziland on projects where payment is not at risk. Construction and mining overview for the past 12 months. Construction and mining's contract revenue increased from 5 billion rand to 5.3 billion rand, and operating profit decreased from 166 million rand to 112 million due to the liquidation of an open-pit mining client and a loss-making project in the Roads and Earthworks division. Zambia and Swaziland continue to contribute positively towards operating profit. Slow and delayed payments from both the Nigerian and Zambian governments on the historic outstanding amounts continue to negatively affect our working capital. Work has been stopped in Nigeria until sufficient payments have been received. Payments received from Zambia remain sluggish and no work has commenced on the affected projects. We are in ongoing discussions with the Nigerian and Zambian governments to resolve the outstanding payments. None of the outstanding debts are in dispute. Several projects in South Africa have also been affected by unlawful community unrest, having a negative impact on our financial performance. Work prospects for construction and mining. Even with the decline in capital spend, there are still some opportunities both locally and cross-border. In South Africa, there are opportunities within selected open-pit mining projects, surface mining-related services, water and sanitation treatment plants, and large diameter pipelines. And cross-border, there are opportunities within water and sanitation treatment plants, large diameter pipelines, general contracting work in the built environment, and selected roads and bridges. As an established general contractor in neighboring countries, more infrastructure opportunities are available for our multidisciplinary offering. In the short term, there are potential awards to Stefanutti Stocks to the value of plus minus 3.6 billion rand. For the next 12 months, projects to the value of approximately 9.7 billion rand have been identified to be priced. Building percentage turnover and order book by sector. During the past year, most of buildings turnover came from office and commercial buildings and factories and warehouses. With the current order book, this is expected to continue. The combined turnover of residential, energy generation, and tourism and leisure makes up almost 40% of buildings turnover. With the current order book, this is expected to continue. The order book in Southern Africa has declined to 2.6 billion rand, which is the lowest it has been in the last 5 years. The reduced building-related turnover has had a negative impact on the working capital cycle. Just under 20% of buildings turnover came from the public sector in South Africa. This is predominantly from the Kusile Power Station project. 56% of the projected work outside South Africa is from Mozambique and the UAE, where traditionally we have achieved better financial results. Building overview for the past 12 months. Contract revenue reduced from 4.4 billion rand to 3.4 billion rand, with an increase in operating loss from 4 million rand to 251 million rand, which includes the IAS 37 provision of 263 million rand as previously mentioned, but it excludes the UAE equity accounted operating profit of 63 million rand. The equity accounted UAE business produced another good performance. The building market in Southern Africa remains depressed and challenging. Mozambique and the coastal regions in South Africa continue to contribute positively towards operating profit. Continued delayed payments from developers contracting to the Department of Human Settlements is putting pressure on working capital. With respect to the large project for the national energy provider, the group is actively pursuing its contractual rights to ensure that the costs provided for in terms of IAS 37 and the corresponding cash flow implications will not materialize. In addition to this, other contractual claims and compensation events are being pursued. Building has also been affected by unlawful community unrest and informal business forum rogue behavior. Work prospects for building. Although margins are expected to remain under pressure in the short to medium term, opportunities continue to exist in office buildings in South Africa and Mozambique. There are a number of residential urban development projects, design and construct and factories and warehouses. General contracting work in Mozambique offers good opportunities at fit-out and building work in the UAE. In the next few months, we expect potential awards to Stefanutti Stocks to the value of approximately 2.8 billion rand, and for the next 12 months, projects to the value of plus minus 8 billion rand have been identified to be priced. Mechanical and electrical percentage turnover and order book by sector. With previous contract awards from mining houses, a larger percentage of mechanical and electrical turnover has been generated from surface mining related work. Although there is a shortage of work in the traditional petrochemical market, the uptick in the tank farm market should improve the oil and gas division's order book. Work outside South Africa in this business unit is low. Mechanical and electrical overview for the past 12 months. Contract revenue increased to 1.2 billion rand, with an operating loss of 19 million rand due to the previously reported claim against the oil and gas division by an international contractor, which was settled under duress and had a 38 million rand negative impact on the results. In a challenging trading environment, the mechanical division performed to expectation. During the year, the business unit was right-sized due to a shortage of work. The contract cancellation in December 2016, which was referred to arbitration, has been delayed to a future date. Work prospects for mechanical and electrical. Surface mining infrastructure offers opportunities in the iron ore, platinum, mineral sands, and coal sectors for the mechanical and electrical and the instrumentation divisions. Plant maintenance and shutdown work continue to create opportunities for oil and gas and electrical and instrumentation divisions. Some fuel storage tanks have been awarded to oil and gas, and we expect more tenders to come to the market within the short to medium term. In the medium to long term, we are expecting clean fuels projects to offer work prospects. In the short term, there are potential awards to Stefanutti Stocks to the value of plus minus 615 million rand. For the next 12 months, projects to the value of approximately 2.3 billion rand have been identified to be priced. For the group, the percentage turnover and order book by sector is as follows. The UAE operation is included as part of the building's order book in the graph. Surface mining related services and transport infrastructure continue to make up a large percentage of the group's turnover and current order book. 43% of the order book is secured from outside South Africa. Less than 20% of our turnover in South Africa comes from the public sector, consisting of bridge construction, energy generation, and water and sanitation. Public sector work outside South Africa mainly comes from Botswana, Mozambique, and Swaziland. This slide represents the operating segments as we manage our business. At financial year end 2018, the operating margin for construction and mining was 3.3%. Relative to February last year, turnover is up by 345 million rand, but with a decrease in operating profit to 112 million rand and with an operating profit margin of 2.1%. Going forward, and based on the current order book, we expect a similar turnover but with an improved operating profit margin. At financial year end 2018, the operating margin for building, including the UAE, was 0.8%. Relative to February last year, turnover reduced by 585 million rand, and should one exclude the IAS 37 provision, the operating profit margin is 1.6%, including the UAE. Going forward, and based on the current order book, we expect the building business's turnover to be similar to that of 2019, with an operating profit margin similar to that of 2019, excluding IAS 37 and including the UAE. The UAE had a very good year, but we expect that the current level of profitability will be difficult to sustain. At financial year 2018, the operating margin for mechanical and electrical was 1.3%. Relative to February last year, there has been an increase in turnover of 185 million rand with a loss of 19 million rand due to the settlement cost of 38 million rand in the oil and gas division as mentioned earlier. Going forward and based on the current order book, we expect mechanical and electrical turnover to be similar to that of 2019. From a group's perspective, for the full year, we expect turnover to be similar to that of 2019. The operating profit margin is expected to improve from that reported at 2019, excluding IAS 37. I now hand you over to Antonio for the financial overview.
Thank you, Billy. These results are in line with a trading update released on SENS on the 16th of May, indicating EPS to be a loss of between 60 and 70 cents and HEPS to be a loss of between 65 and 75 cents. These results are characterized by the following factors as highlighted by Billy. So in summary, a trading environment that remains challenging, an IAS 37 provision raised for a public sector power project in South Africa, continued pressure on working capital due to poor liquidity in the market, the liquidation of a contract miner, and the funding of the large public sector power project has resulted in the group experiencing short-term liquidity pressures, and the adoption of IFRS 9, financial instruments, IFRS 15, revenue from contracts with customers, and IFRS 16, leases. With IFRS 9 and 15, retrospective application, thereby necessitating a restatement of prior reporting periods, and IFRS 16, prospective application with a 36 million adjustment to the opening balance of property, plant and equipment and interest-bearing liabilities effective 1 March 2018. Some financial indicators: contract revenue 9.9 billion, operating loss of 158 million, operating profit excluding the IAS 37 provision is 105 million at a margin of 1.1%, headline loss per share of 70 cents. Moving on to the statement of profit and loss. Contract revenue for construction and mining and mechanical and electrical increased by 345 million and 185 million respectively, offset by reduction in building revenue excluding the UAE of 1 billion, resulting overall in a reduction in contract revenue of 490 million. In terms of IAS 37, a provision of 263 million has been raised relating to a large public sector power project in South Africa. The group is actively pursuing its contractual rights in terms of the contract and awaits an outcome from the dispute resolution process that has been initiated. This provision has resulted in the EBITDA margin reducing to 0.6%. There's been an increase in the depreciation charge to 211 million from 176 million of the prior year, which includes an IFRS 16 right of use charge of 45 million. This all results in an operating loss of 158 million. Should the IAS 37 provision be excluded, the operating profit is 105 million, as opposed to the 161 million of the restated prior year excluding the impairment charges. There has been an improved contribution from the UAE operation from 48 million of the prior year to 66 million. There's been a reduction in interest earned to 44 million and an increase in interest paid to 101 million due to the significant capex incurred in the prior year and a 8 million rand IFRS 16 interest charge. The tax charge is impacted by the IAS 37 provision, varying tax rates of cross-border jurisdictions, and the non-taxable contribution from the UAE operation. Loss after tax for the year is 111 million. Excluding the IAS 37 provision, profit after tax is 78 million, which is a 35% reduction from the restated Feb 2018 profit after tax of 120 million, excluding the impairment charges. Weighted average number of shares in issue have reduced due to the repurchase of our own shares in the first half of the year. All this results in a headline earnings per share, excluding the IAS 37 provision, of 42.8 cents compared to the 67.5 cents of the previous year. Moving on to the statement of financial position. On the asset side, capex spend for the year is 109 million, excluding 70 million IFRS 16 right-of-use assets. Of the traditional capex, 68 million is for expansion and 41 million for maintaining operations. Of the 68 million, 50 million was for a development in Maputo for own use, rather than renting expensive accommodation for our expatriate staff. The payback for this investment is less than 4 years. Due to clients delaying the certification of work in progress has increased from 409 million at February 2018 to 507 million. There has been a 16.7% decrease in trade accounts receivable, with days in debtors having reduced from 77 days at February 2018 to 68 days, which still exceeds our target of 60 days. This is primarily due to the outstanding amounts due by the governments of Zambia, Nigeria, and indirectly South Africa. These governments continue to slowly service their debt, which are not in dispute. We have stopped work on these projects and will only resume when payment is received. Ongoing discussions are being held with these governments to resolve these outstanding payments in order to reduce our exposure. Net cash on hand of 881 million has been impacted by the liquidation of a contract miner, delayed payments from customers, and the temporary funding of the large public sector power project, which is impacting on the group experiencing short-term liquidity pressures. In order to resolve this, the group is exploring raising the required funding through a combination of specific ring-fenced project financing, a number of alternative funding solutions, and, only if required, a possible fresh issue of shares. The first part of the funding plan, being the specific ring-fenced project financing, has been secured. The remaining aspects of the funding plan are being pursued. Shareholders will be advised accordingly. Based on the successful implementation of the remainder of the funding plan and the current assessment of the group's financial budgets for the ensuing year, the group is deemed to be a going concern. Moving on to the liability side of the balance sheet, total interest-bearing liabilities have decreased from 783 million at February 2018 to 637 million. However, This includes 61 million of IFRS 16 rental plant assumed liability, and if this is excluded, then interest-bearing liabilities are reduced to 576 million. The debt-to-equity ratio reduced to 36.5% from the 43.7% restated at Feb 2018. Furthermore, if the IFRS 16 liability is excluded, then the debt-to-equity ratio is 33%, which is below our internal measure of not exceeding 35%. On the current liability side, creditors' days have decreased to 35 days from 37 days. However, other current liabilities have increased by 29% due to an increase in amounts owing to subcontractors and retentions. XX billings over work done in total increased by 60 million to 1.2 billion. There has been a 102 million increase in total provisions from 657 million at February 2018 to 760 million. Moving on to the cash flow statement. Cash generated from operations of 115 million is in line with the operating profit excluding the IAS 37 provision. Working capital contributed 246 million towards the cash balance as opposed to the 293 million consumed in the prior year. For this presentation, I have split investing activities in the old way of preparing the cash flow statement, split between CapEx acquired to maintain operations and expand operations and other investing activities. A similar adjustment was made to financing activities, with 242 million of debt being repaid during the year. All in all, there has been a reduction in cash from Feb 2018's 916 million to 881 million. In conclusion from my side, resolving the short-term liquidity issues is the main priority. The need for a fresh issue of shares will be continuously assessed in light of various alternatives. I now hand you back to Willie to close the presentation.
Thank you, Antonio. There are some challenges in the business. As mentioned by Antonio, we are working hard to resolve the short-term liquidity issues. We will maintain focus on converting debtors and work in progress into cash, resolve the contractual claims and compensation events with the national energy provider on a specific project, and although challenging, it is important to obtain a quality order book in this distressed market where public and private infrastructure spend is limited. There are some work prospects for the group. Some of the short-term opportunities, as per the presentation, which amounts to plus minus 7 billion rand, have been awarded during the course of this week, and further awards are imminent. For the next 12 months, opportunities, as per the presentation, amounts to plus minus 20 billion rand. Longer-term opportunities exist in the Clean Fuels program, various surface mining-related services projects, various types of building projects, the LNG plant in Mozambique, and the Lesotho Highlands Water Project. Should the government stimulus package materialize, it could create opportunities for various divisions within the group. We are also considering various cross-border opportunities in road and bridge construction, bulk pipelines, and office buildings. Industry-related matters. With regards to the civil claim received from the city of Cape Town relating to the Greenfront Stadium, a trial date has been set for the first quarter of 2020. The group remains confident that it can defend this claim. In conclusion, we need to resolve the short-term liquidity pressure to ensure that the group is well positioned to benefit when opportunities arise. Cash management remains all-important, in which the collection of outstanding government debt is a priority. The group remains focused on preserving and improving its balance sheet. With the better returns from Sub-Sahara Africa, we will continue to expand our cross-border operations. This brings us to the end of the presentation. We now go into the question and answer session. Thank you.